Good luck with that. Now then, he's back to help you save more money. So it's Martin Lewis, and he's here. What's on the show tonight? You're on the telly.
Yeah, it's a big one tonight. It's all about family finance. It's the biggest question I ever get is, where should I put the children's savings? So I'll be answering that, but also the questions people don't ask, things like life insurance, saving in a pension for your child. Yes, that's a real thing too. How to cut the cost of childcare, the grand parental tax credit. So it's a big feast of all the financial things that involve kids. It's a must-watch. If you've got children or you're a parent, a guardian or a grandparent, we'll be on at 8 o'clock tonight, as well as I'll be taking everybody's questions and my normal news you can use too.
All right, sounds good, thank you. Right, we've got some questions for you now, and Evelyn has got in touch and she said, I've completely forgotten about filing my self-assessment tax returns for this year and I don't have time to get everything in order before today's deadline. Will I be penalised for not having everything in order in time?
Almost certainly yes. Look, the self-assessment deadline is today. And the rule is pretty simple. If you're asked to do self-assessment, you have to do it. Usually it's people who are higher earners or have more complicated tax affairs. But the rule is if you're asked to do it, you have to do it. Now, if you miss today's deadline, you are usually given a £100 fine. Now, if you had a really good reason why you couldn't do it, for example, you'd been in hospital or your partner might have done, you can get in touch with them and you can discuss that reason. But if it's just you've forgotten, then no. Actually, probably more important than the £100 fine is there are two separate things that happen today. The £100 fine for not filing your tax return, and also you're, in most cases, meant to be paying your tax by today. If you haven't done that, then take a guess of roughly what you should be paying and pay that, because that would reduce the interest, and if you don't get to it in time, the penalties later. If you miss today, there's another fine in 30 days. So the real key is if it's not going to happen today, make a payment of an estimated amount if you can. I spoke to a tax accountant just before, actually, on this exact issue, so I'm parroting what they told me. Make a payment if you can. The £100, you're probably going to have to cope with that fine, but make sure you get your tax return done in the next 29 days, or that's when the next fine happens.
All right.
Thank you.
Hope that helps, Evelyn. David said, my eldest son is leaving the UK to travel around Asia this summer, but still has over £25,000 left to pay off from his student loan. He will be travelling for about 18 months to 2 years. Will he have to continue to repay the loan whilst he's abroad?
Well, yes. I mean, it's a myth that you don't pay student loans if you're abroad. Technically, the student loan is a contractual payment. So some people, if you were to move abroad forever, you would owe the money. But if you never came back to the UK, you'd be unlikely to be prosecuted for it, which is, I think, where the myth comes from. But you've signed a contract to repay that. Now, what it's worth remembering, assuming that your son went to university, started university after 1998, the amount he has to pay is in proportion to what he earns over a certain threshold. Now, when you go abroad, the threshold depends on the country you're in. The cheaper the cost of living in that country, so generally a poorer country, the lower the threshold. The more expensive the cost of living, generally a richer country, the higher the threshold. But the truth is, if your son's going abroad for a couple of years and he's not working while he's there, then even though he's eligible to pay, he won't be earning over the threshold. If he is working, then he probably will have to pay, and the threshold depends on the country. As he's going away for more than 3 months, he should get in touch with the student loan company and tell them. But he will, just as he does in this country, he will have to pay a proportion of what he earns over a set threshold. And what that threshold is will depend on the country he's working in.
Thank you, well done. Yeah, thanks, David. Right, Chris says, I'm 22 and have a relatively good salary. I'm trying to buy my first house with my girlfriend. We are both maxing our monthly Help to Buy ISAs as well as other ISAs. Should I keep saving into the Help to Buy, or should I put my Help to Buy money into a LISA and put more money into it? Did you follow that?
Yeah, I did, but boy, are these some technical questions today, so I shall do my best to try and make it make sense for everyone. There are the Help to Buy LISA and the Help to Buy ISA and the Lifetime ISA are both products for first-time buyers, where when you save in it, the state adds 25% on top. So in the Lifetime ISA, you can save £4,000 a year, and the state will add £1,000 on top as long as you're using it to buy a qualifying first-time property, which with a Lifetime ISA is a home under £450,000. That hasn't gone up since it launched in 2017, which I actually think is a mistake, and I wrote to the Chancellor about that the other day, asking if they would look at that issue. Now, the Help to Buy ISA was its predecessor. You can put less in a Help to Buy ISA. So I can see why you'd want to go in a lifetime ISA. There are a few problems. First of all, you can only move up to 4,000 across from your Help to Buy ISA to a lifetime ISA in this tax year. And so if you've got a lot more, you're going to struggle to move the money across. The second issue is you have to have a lifetime ISA open for a year before you can get the first-time buyer's penalty. So if you don't have one open and you're planning to buy in the next year, it's pointless. The third problem with moving money across to a lifetime ISA is that if you don't use it for buying a qualifying house and you want to take your money out, you'll pay a penalty of 6.25% of what you put in. There's no penalty for withdrawing money for a Help to Buy ISA. So a Help to Buy ISA is more flexible and much easier to use. A lifetime ISA, you can put more in, so you get a bigger bonus, and also you can buy a bigger house with it because the limit on a Help to Buy ISA is £250,000, except in London, where it's the same as a lifetime ISA, £450,000. So whether you should move it to a lifetime ISA or not is a bit of a, it depends. If you're buying quickly, no. If you're buying, thinking buying 3 or 4 years away, you might be able to move more money into the lifetime ISA, so it's probably worth it, as long as you're definitely going to buy a qualifying house. But what I really suggest you do, there's information online, I know there's information online, that compares and contrasts the two, and you should do a careful study of which one is best for you at this point.
OK, thank you. Sarah says, I have close to £12,000 in saving, and I'm considering using that to take a big chunk out of my student loan. £36,000 remaining to pay. My hope is that it will stop interest from building up, but would be taking off a chunk actually make a difference in the long run. Do you know what? Until this morning, I had no idea, because my sort of girls are grown up now, why would you, that there was actually interest on a student loan. I mean, for those who said, it was pretty harsh, you'd have to pay it in Scotland anyway, but it was harsh in the first place. But the fact that it would accrue, and so there's interest when, even if you don't earn enough to pay it off, it's still accruing.
You sort of got the problem with the interest issue is actually there is interest added to your account. That is not the same as saying that people pay interest. I mean, if you never earn above the threshold, you won't pay anything. If you earn a little bit above the threshold, you won't pay back what you borrowed in the first place. So it's middle and higher earners who pay the interest. The middle and higher earners after university who pay the interest. So the interest, it's terrible the way we communicate student loans. It absolutely petrifies people. The interest rate is up to inflation plus 3%, which is, of course, a lot at the moment. But for many people on the lowest incomes, you should simply ignore the interest because you'll never pay it because you won't clear the loan in the 30 years before it wipes. And that is the difficulty with this question. While interest, and a lot of interest is being added at the moment, you have to work out, is that interest you'll actually pay or is that interest you won't pay? Now, what I don't have in this question is any indication of how much, whether you're a higher earner. If you've gone into a high-earning profession where you're going to see pay rises going up and up and up, then yes, clearing the loan will work. If you're on relatively low income, you're at or a little bit above the threshold and you're not likely to see big pay rises over the next 30 years, and you might take time off for, I don't know, maternity or career change or go work for a charity on a low income, then no, don't pay it off because it would be throwing the money away because it won't save you anything because you'll still keep repaying only if you earn above the threshold for the whole 30 years. So it is a difficult equation. I would also say I would always prioritise more difficult financial challenges, like saving for a mortgage deposit. If you were ever going to need a loan, like to buy a car, I would have the money aside. You don't pay off your student loan and then have to go and borrow back at those more, while the interest rate might be lower, the terms are much worse on mortgages and commercial loans than they are on student loans. So it is a complicated decision to make. I would absolutely not pay it off unless you're certain you're going to get close to clearing that loan within the next 30 years. Otherwise, if you do pay it off now and you want that money back later, you cannot do it if you voluntarily overpay. So it's a difficult one to answer. It really depends on how much you're going to earn over the next 30 years.
Thank you very much. We'll see you on the telly tonight. Thank you. Right.